And Prasanth Prabhakaran, Senior President and CEO, Yes Securities. So much to chat about. Thanks so much for joining in. To begin with, let's talk about the current market scenario at hand. I believe you have a fairly negative stance for the markets and think that a lot of concerns are brewing. So what are the topmost concerns that you think our markets will be impacted by? And do you think that we're likely to remain in a tight range?
Yes. So the fact remains that we are very close to the range that we had discussed in the last time that I have come on your show. My expectation was that we should be anywhere in the range of 10,400 to 10,600. On the lower end, we should be at around 9,600 to 9,800. The reasons are simple. One is that 35% of the entire Nifty portfolio is compromised by financials, and my personal feeling is that financials won't be ending up coming out with great results for the current quarter. Even the advanced tax numbers that Axis Bank and both ICICI Bank and Axis Bank have put in weren't great. There are pressures, upward pressures on the interest rates that have been there, and that indirectly will also affect NBFCs in giving solid results out. So you have problems as far as results are coming in, and the entire result season is still left to be coming out. That is one portion of it. Apart from that, we had and we continue to have a major concern as far as crude is concerned. We expect an up move which will happen in the next 5 to 6 months, which will also coincide with our election season that is there. And any up move in typically the crude prices that are there affects inflation. It affects the chances of having an increase in rates again coming in as a worry. So there are a lot of headwinds at this point of time. I would love to see a good result season coming in, but my feeling is that it will be muted rather than being better than what we have seen in the last 2 quarters.
Minority, most on the street believe the earnings season actually would be net be neutral to slightly on the positive side. What are your thoughts going into FY19? Do you see 15%, 17% kind of earnings growth coming in for indicative purposes, Nifty earnings for FY19 at least? Do you see earnings gather pace from here on, or one can't really take a clear call still on FY19?
No, Ajay, our feeling is that it will be in the range of around 12 to 15%, preferably on the lower end of the spectrum than on the upper end that I am talking about. The fact remains that we have had considerably tough times that have gone by in this quarter that has happened. You have FIIs which are selling continuously in the market on the one side, because the valuations are still high and earnings have not caught up with the valuations at this point of time. And the only way that can happen is that I do not expect earnings to go back to your 15-20% which we haven't seen for the last 5-6 years. The fact remains that at the current valuations that are there, we would preferably be at the lower end of the spectrum than at the upper end of the spectrum as far as earnings is concerned. And we continue to believe that that is the range that will be maintained.
I'm tempted to ask you about private sector banks. I would not, you may not want to talk about stocks in specific, but what I want to know from you as a market participant is, if one were to dissect the private sector banks into two, one is corporate private sector and the other is retail private sector, and of course one is a mix of both. Retail private sector is doing very well, both the stock price as well as on the business side, but private corporate is not doing well on credit growth side nor on the stock side, on the market side. Do you think that in the next 6 months a bottoming out may happen on the corporate private sector banks relatively, and the leadership of retail private sector may actually reverse, or you think it is early to say that?
Frankly, Ajay, in Q2 end, after the results had come out, we were more or less confident that private sector banks, actually the entire corporate bank pack had ended up bottoming out. The NPAs had slowed down. There was a slight increase in credit offtake that was there. But unfortunately, the Q3 results turned it on the head, and post that you had the PNB crisis. The fact remains that private sector bank and the NBFC pack both are going to benefit because of the slowdown in credit offtake from the public sector enterprise, which is even in a more worse state than the private sector banks that are there. The corporate bank pack will end up having a bottoming up effect once you have declared your NPAs and you are looking for the next level of growth after raising money, which is going to be reasonably large because you need money to be raised. Retail will continue doing well because both HDFC and Kotak, the pure retail players in that space, has had an NPA level which has been outstanding. They have managed to keep it under control. You have a clear opportunity out there to make a clean 14 to 15% return CAGR at least for the next 2 or 3 years clearly, and having better results once this entire economy picks up a little more. So preferably, at least for the next 1 year, it is still a retail play which is going to be there. The corporates will take a little more time before they find their feet. A lot of them has to sell off assets to end up ensuring that they come out of the NPA crisis that is there, or they are on the verge of defaults. All this cleaning up will be done over the next 2 or 3 quarters. So corporate banks taking off in a large fashion, except the ones which have been beaten down because of news, will take some more time. So it's a better play to end up having a retail bank into your portfolio. Be happy with a conservative 13 to 15% returns that you get from that entire space, and be safe is all that I can end up saying. But if you are the adventurous kind, then obviously you can look at and find an opportunity to slowly build a portfolio on corporate banks which will give you results in not more than around 9 to 12 months.
Okay, that's a view coming in. I would also like to question you about the outlook on the capital goods space, what the outlook is from a sector perspective, because the sense that we're garnering is that we've seen across the board stronger order growth. You have seen the overall private capex as well picking up. The government's thrust on individual sectors have helped drive manufacturing and factory order recovery as well. What is your view on companies such as L&T, BHEL, etc. benefiting on the back of this, and any sense or any numbers that you're penciling in when it comes to the earnings as well?
So the fact is that it's in the last quarter that the pickup has started in a large fashion. The road network has shown practically a double bidding that has happened, and the disbursal that has happened from the government side. They have ended up giving orders to that size, and it will continue to become robust. Are actually the 3 sectors that we have liked and concentrated for the next 1 year because of election and because of the various headwinds that we spoke about has been in infra. It has been in the consumption space, which we believe is conservative, so won't have a very high volatility that is going to be there. And the third one is the rural segment, because we believe that government expenditure into these segments will happen. So in that, if infra, the projects have started flowing out the way the government has taken in the current quarter, my belief is a lot of capital good companies, including L&T, which is the largest practically player, which will end up having a book which will be extremely large. The other smaller players will also do well. L&T will end up giving a return of approximately 15 to 16% for the next 2 or 3 years. But the smaller players, your Sadbhaus, Dilip Bilcons, are the ones which will end up having a multiple effect because the size of their balance sheet is also small. So you have smaller players which will give you a large alpha on your portfolio, but the larger players that are there will end up giving you your subdued returns because of the simple fact that they have a base which is already large.
All right, Prasanth, we'll let you go on that one. Thank you so much for your time today.